Hey, welcome back. Getting back with 4 more companies that you recommended. From high dividends to growth potential and business quality, all of them are interesting, but it's ultimately a matter of price, so let's look into them. Really quick, if you enjoyed this, please leave a like and a comment to help me out. Everything is and will remain free. Now, Albemarle, this is currently the second largest lithium producer on the planet. Following some investments, they see a huge increase in production, as you can see on the screen, but more on this in a second. They presented some demand expectations for the end of the decade. Even though they cut it and with all the increase in supply, there might still be a pretty significant supply gap, which can be very good for the price. But then, if the lithium is expensive, so is the battery and the car, which can affect the demand, but that would be an issue in the second part of the cycle. Until then, it can be beneficial and can lead to a potential jump in price. We can see very volatile cash flow as a result of the price of lithium jumping and then falling, plus very significant capex. They are investing a lot following a couple of good years, which is normal in the industry, and we can see pretty much every other company doing it. I think it's good that although they are slowing down a bit, they aren't stopping the investments, because if there is another boom in lithium prices, they would be ready to reap the benefits. They provide an outlook which gives a pretty good idea about what they can produce. I'll use 2027 as a reference. Let's say they convert 40% of the EBITDA into operating cash flow as before, and the normal capex is 1.2 billion, more projects plus inflation, so higher maintenance capex. They see a significant increase in production to around 320,000 tons in the following years as the projects ramp up, so let's also increase the EBITDA at a 20% compound annual growth rate like the production. So, based on the numbers they provide, they should barely break even when lithium is at 20, but what happens if lithium is at 10, 7, 5? Even at 20, there is interest, debt, dividends, so that's not enough. Sure, if it's 40, 50 or more, that's very good, but what if lithium demand doesn't grow? With so much money and research going into finding a potential alternative, there is quite a bit of risk. The thing is, lithium is all about batteries. If that demand isn't there anymore, a majority of the companies go bankrupt. But on the other hand, with EVs and energy storage developing, if something doesn't come, lithium and lithium companies should do very well. It's once again all about risk and reward. Financially, they are in a very good position, with the current assets covering almost all the liabilities. That means we have 11.8 billion in equity on a roughly 11 billion market cap. Sure, without the goodwill it's about 10.2 billion, but still pretty good. It's a bit high compared to the competition, but when you say lithium, this is the company that the market thinks about first, so they will likely be at a higher valuation, especially since they are American. We can see, however, that the entire industry is getting into this potentially undervalued point, so now is definitely the time to look into lithium. But with all the investments and the negative cash flow, the balance sheet may be affected in the near future if they want to finish the projects. They can also issue shares, but doing it at some of the lowest levels in the past decade isn't a good idea. However, in the outlook, we can see that they plan to issue around 20% this year, meaning about 2 billion today to fund the projects. Maybe after the dilution, at the end of the year, if lithium prices are even lower, this could be a good time to consider buying. They see over 280 million in productivity benefits and restructuring cost savings, so the cash flow that we calculated may be better. It won't all go into the cash flow, but it can have an impact. But it's probably not enough to make the margin of safety significant. I think they have to maybe think about optimizing the portfolio, because right now some of the mines require a lot of capital and as a result the production cost is high. I think they are an okay way to get exposure to lithium's long-term potential. For me, it's very important to have the balance sheet and the production cost that would allow them to survive in any point of the cycle. Of course, that usually comes with a premium, so the potential is lower, but so is the risk. To be fair, I wouldn't buy them because I want more potential and they seem to require lithium at pretty high prices to do well. I prefer SQM if I had to pick one of the big companies because they have a better production cost and much better dividend potential, but this isn't terrible either. It's probably a sure way to benefit from lithium in the long term, assuming that it does grow. If it doesn't, then they might have issues. And that's again a criteria that's very important for me. And sure, they don't have to mine if it isn't profitable, but even then they have pretty high costs and restarting the production can take months. Now Pfizer, this is one of the largest pharma and biotech companies on the planet. They make medicine and vaccines for a variety of branches of medicine, with about half of the revenue coming from the US. You can imagine that during the pandemic they had some exceptionally good years, but that probably won't happen again. However, they are getting to some of the lowest prices in a decade, so they might be interesting. They pay a very nice 6% dividend, meaning about 9.6 billion, which is a lot of money for them. They had some issues lately leading to a lower cash flow, but before the pandemic they were making around 10 to 14 billion, which would be a very high payout ratio. They need close to 4 billion in interest payments, so that can be a pretty big issue today. Financially, they are in an okay shape, with the current assets barely covering the current liabilities. However, we can see that the long-term debt doubled in 2023. They did that to buy Seagen, an oncology drug developer. They plan to lower it and already managed to pay a bit, so it should be okay. The goodwill is also huge as a result, by the way, so 92.5 billion in equity but 70 in goodwill. So you don't really get that much equity, but it's not really that relevant in this kind of industry. The problem is that this drop in cash flow may not be temporary. Sure, there is the impact of the COVID-related stuff, but even then, what happened to the rest of the company that was making like 12 billion a year? I can't find some restructuring or acquisition-related costs or capex that would justify such a drop. But there is potential for other successful drugs to boost the cash flow again, especially after they bought Seagen. Still, that's an uncertainty, and that kind of industry is very risky. We don't know how much they can produce together at the moment, but they were losing about 700 million per year on 2.3 billion in a pretty rapidly growing revenue. Obviously, they didn't buy them to profit today. It's a lot of money put into a very high potential long-term investment. They see about 10 billion in revenue from them by 2030, meaning about a 4x, which can be relatively okay. But 43 billion, or a quarter of the market cap, for something that's ultimately a gamble is a huge amount of money. Buying at 20x the revenue, not the cash flow or the profit because they lose money, is often way too much in any industry. You know, at a, let's say, only 15% conversion to cash flow, that's 1.5 billion, so not a lot. From the looks of it, the market doesn't seem to like it right now, but I think it's mostly about the cash flow. You know, double the debt and the interest to make negative money, which can put pressure on the dividend. And that's, I guess, a good point. If they cut the dividend and focus on repaying the debt, the balance sheet can improve relatively fast. If that happens, we can expect even more pressure on the stock, as probably a majority of the people who bought during the pandemic boom and still haven't sold yet give up. But then, this can become interesting. You know, they can improve the balance sheet and lower the interest, and if they get some very fast growth from Seagen, they can maybe bring 10, 12, 15 billion per year again. Sure, it can be even 20 billion, but even then I don't see that much potential, especially if I buy today. Maybe if the price falls and the potential dividend would get to, let's say, 8-10%, it could be okay, but right now, when there is some risk of falling even more, I wouldn't buy them. You know, if I want dividends or growth, there are currently better options in the market. But I'm not sure how much we can trust this management, and it's not just the overpaying for Seagen, but the decades of potential corruption, bribery and stuff. Now, L'Oreal, this is the number one in beauty products on the planet, with several big brands for different audiences. They are also diversified from a geographic point of view, with 37 factories on the planet, and Europe, North America and Asia providing a relatively similar share of the revenue. They have a lot of huge brands addressing different audiences, and it's impressive to see so many big names under a single company. They kept buying a lot of brands over time, which had an effect on the revenue, the profit and everything. We can see some growth in e-commerce, which can help them grow a bit more than the overall market. Anyway, it was a record year again as a result of constant acquisitions and developments. It's pretty much the company's business model to develop this way, and as long as they can find a niche or a company that can help them deliver growth, they should be okay. But at such a valuation, if they don't meet the market's expectations, the stock can be in trouble. They pay a relatively small 1.6% dividend that they keep increasing, representing a 55% payout ratio based on the profit. Financially, they are in a very good shape, with the current assets covering the current liabilities and overall not a lot of debt. The cash flow can basically pay the whole debt in about a year, so really nothing to worry about. But, similar to Nike for example, you don't get a lot of equity, especially after you deduct the goodwill. But again, something that's not on the balance sheet is the value and the potential of the brands. Again, they have some of the most powerful beauty brands on the planet, and they might as well be worth even 200 billion. An issue that may not necessarily affect them, but you have to remember about the industry, would come from the regulatory side. Either some ingredients won't be allowed anymore, or there are some new environmental requirements. Any of this can have an impact on the cash flow. To be honest, I think this would be more of an issue for the competition because they seem very trustworthy when it comes to this. Plus, a recession should be pretty bad for a company like this, but as I said in other videos, the time after it, when the rates are cut, can be pretty beneficial. They are considered consumer defensive, although in case of issues, they would be one of the first things that people give up on out of all the consumer defensives. The thing is, even if there is some brand loyalty, it's not really something that you can rely on forever. Sure, there is quite a lot, but when you have more and more options, you might eventually try and like something else. They still have to develop new products and fight the competition through marketing, which can cost a lot of money. There are countless similar companies that either go for a certain niche or the general public, all of which can take a bit of market share. At the end of the day, this is a 200-something billion company making around 5 to 6 billion per year, trading near all-time highs. The thing is, this is already a very mature company, so other than the organic growth of the market, it's pretty much mandatory to buy a competitor or something if they want to please the market. I wouldn't buy at 200 billion, but at something like 100 to 120, this can be pretty good. But that's very far from the current price and it's pretty unlikely to see. You know, they can still do okay and it's a very good company, but I wouldn't pay this much, although it's probably around a fair value. They should probably be okay in a low-risk retirement portfolio. But you know, that's not my investing goal, so for me it's a no right now. Now Veolia, this is a French company with operations in 57 countries. They offer a variety of services related to water and waste management as well as energy. Despite the stock price not showing it, we can see very nice increases in revenue, EBITDA, net income and so on lately. You can imagine that this is a very defensive sector and it's likely here to stay for decades, so for a good dividend and a bit of growth, this can be a good option. After acquisitions and during an investment cycle right now, they can make around 1.5 billion in cash flow, which isn't terrible for a 20 billion market cap. So making 1.5 billion euros valued at 20 billion, while waste management, an $80 billion company, makes around 2 billion. And they aren't in a better position or something, it's clearly a smaller company that gets much more attention because it is American. They want to invest 2 billion into a green up plan, which would position them even better to take advantage of future trends in the industry. By 2027, they target an EBITDA of at least 8 billion, meaning at least 36.75 more than a year ago. The net income would grow at a roughly 10% compound annual growth rate during the same time, which is great for a company in the industry. I don't really like how much of the EBITDA they turn into cash flows, but this isn't some huge margin industry and there is a lot of competition. If they get to even 2 billion in cash flows, even though when the investment cycle is over they can probably make even 2.5 or 3 billion, the current ratio would be at 10, which is relatively good. They pay a 4.5% dividend, meaning a bit less than a billion, so around a 60-70% payout ratio. They expect it to grow in line with the EPS, so by 2027 this can easily be above 6%. Financially, they aren't in the best shape, with the current assets almost covering the current liabilities and with quite a bit of debt. They have a lot of goodwill, so you don't really get that much equity. A couple of years ago, they bought a competitor for about 15 billion, which had an effect on the balance sheet, but they are focused on reducing the debt. They see about 400 million in synergies and 350 million from an efficiency plan, so not bad. So overall, with the acquisitions and the plan, this can deliver very good results. They offer vital services and should develop this position even more. By 2027, if they deleverage the balance sheet and the plan is working, the stock may easily double. Again, compared to other companies, this one is actually very cheap, so it shouldn't take a lot to see such an increase. On top of that, they will likely keep paying a 4, 5, 6% dividend or even more when they reduce the debt, so there is definitely a lot of potential. I've known them from some years ago and I can say that I like them and I'm even considering buying. You know, at the end of the day, it's a, let's say, boring company, not some high growth tech stock, but it can have a place in certain portfolios. Once again, a bunch of interesting companies with unique risk and reward potentials. As always, if you like any of them or have any other suggestions, don't hesitate to let me know. Don't forget to check out the other episodes as well. We got to double digits now, so there should be around 40 companies in total. Maybe we can get to 100 by the end of the year. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.